Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. In this video, we're going to talk about dividends and if they matter or not. Some people think dividends don't matter because the money would be better spent reinvesting into the company with capex, and then if your share price goes down the equal amount of your dividend, and then other people think it's good because you're rewarding shareholders that invest in your company and you're like the rightful owner of the company, so you should get paid dividends. And I seen a video that is Dan Loeb, who's a hedge fund guy, and he's a really big investor in Disney, and he was saying that he wanted Disney to just cut its dividend altogether. They did cut it for because of coronavirus and all that, but he wants them to just cut it completely and reinvest all that money into the Disney Plus service to compete with Netflix. So that got me thinking a little bit, and I wanted to do a video on if we think dividends matter or if they don't matter and kind of all that stuff. First though, if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, document my own journey towards financial independence. So I really appreciate it. Give me a little thumbs up. I'd really like that a lot. And subscribe to the channel if you haven't. I'm trying to put out videos every Monday, Wednesday, and Friday. Maybe off a little bit every now and then, but that's okay. So the idea that dividends don't matter goes back to this idea. It's called the dividend irrelevance theory. And it's just that dividends don't matter. And that it's the future earnings that determine a stock price. And paying a dividend does not affect future earnings. And that dividends don't add any value to the company. And part of this is the idea that the share price will decrease by the amount that the dividend is paid. And this is true, but I think it's more like the exchanges do it the day after. They reset the share price to kind of combat like dividend capture strategies where people are only investing to get that little dividend. And a problem with this is has to do with book value, and that the share price is always equally perfectly aligned to book value, because once that money no longer belongs to the company and it belongs to you, the book value should go down, 25 cents per share or whatever. And you usually don't really see this adjustment because there's all the regular volatility in the market and little ups and downs. So you don't see much of a change. But sometimes when a company pays out a big special dividend, then you can see that big adjustment in the share price the next day. But also there's the idea that investors will buy in before the ex-dividend date and run up the share price a little bit. So maybe they cancel out, maybe they do, maybe they don't, I don't really know. Another big thing is the opportunity cost of paying the dividend. What could the company do with the money that they're paying out to the shareholders? Lots of mature companies like Coca-Cola and Johnson & Johnson and things like that, they will pay out a dividend, but they'll keep it, reasonable. Some mature companies like, say, Altria or Philip Morris, they'll pay out a lot more in a dividend because, there's really not much expansion or innovating or growth that they can pursue with that money. So it's better to send that money off to shareholders. And who can spend that money better? You, the investor, or the company that's generating the revenue? Famous example of a company that does not pay a dividend is Berkshire Hathaway. And a lot of the companies in the Berkshire Hathaway portfolio, they do pay a dividend. But Warren Buffett believes that he's better at spending that money than the companies that are paying the dividend. And Warren Buffett is probably right. Some companies also get in trouble, and to maintain the dividend, they take out debt. Example of this is Philip Morris. and they have a payout ratio of 93%. I used to be invested in them, but I'm not now because I didn't really like the payout ratio, and they were taking out a whole bunch of debt to buy back shares and pay that dividend, and I didn't think it was sustainable. They didn't have any growth prospects in the future, so I eventually sold that company out and just left that and moved on with my life. One more thing they talk about is if you want income, you can just sell, the equal amount of shares that, that you want in income. You sell 5% of your shares every year. And I don't know if that makes sense because it wasn't until recently that commissions came down with Robinhood and fractional shares. Those are really new too. You can't really sell fractional shares, only on a few, like maybe Robinhood and M1 Finance. I don't think E-Trade you can really sell fractional shares. So unless you had like a whole bunch of shares where it was just round numbers of shares that you could sell off at like 3 or 4% a year, that idea of just selling off shares doesn't make sense to me. Another problem with dividends is taxes. And when you get paid out a dividend, there's a double taxation to it. The corporation gets taxed once on the corporate level, and then you as an investor get taxed again when you get paid that dividend. So there's, all things created equal, like it would be more tax efficient for the company to keep that money and reinvest it, so you would be rewarded in, price appreciation instead of a dividend. One way they could skirt around the dividend problem is with share buybacks. And instead of getting, some extra money, the company buys back shares with that money, so your piece of the pie gets a little bit bigger. Now, some companies, they can save a lot of money by taking on debt to buy back shares. So if you have a company that's paying something like 5% dividend, and you can take out debt for 3%, buy back those shares, you're saving 2% on that. You're making that 2% arbitrage right there. And that would be, a financial savvy thing to do. But the problem with this one is that you have like the stock options and the CEO compensation stuff, and those often involve creating a lot of new shares. And sometimes all this share creation can dilute their shareholders, so you're spending all this money buying back shares, but giving a bunch of new shares of CEO, and your share count is actually going up, so you're really not, reducing your share count at all. And these share buybacks, no tax, tax-free. You don't get taxed as an investor on that, and the company already pays its tax on its income, so there's no taxable event with share buybacks. But taxes do give dividends like some good treatment. Qualified dividends are taxed at the long-term capital gains rate, which is like either 0% if you're a lower income. I think it's like, it's, you make less than $38,000 a year, you'll only be paying, you'll pay 0% on qualified dividends. And if it's up to like $430,000 a year, you get taxed 15%. Some benefits of taxes are it gives you, the shareholder, the choice to do whatever you want to do with this money. You can take the dividends, reinvest it into the company if you think it's profitable and it's worthwhile and you want to continue putting money into this company. You can take your dividends, invest into a different company, or you can just take that money and spend it wherever you want. You can go to the bar and have dinner or whatever you want to do with your dividends. But once a company's been paying its dividend, it develops a reputation, and it kind of needs to uphold that reputation. We keep track of these things, like there's the dividend aristocrats that we keep track of, and the dividend kings, and there's ETFs that keep track of this, like SDY and Noble. So a company gets this reputation, and they do want to keep and maintain that reputation. The longer a dividend's been paid, it shows that a company's been through, business cycles and crises, and, you know, ups and downs in the economy. And it's been around for a long time, and it's surviving, and it's stayed profitable through all these times. There's some famous studies. I'll link the link in the description box, but one of them compares, you know, a whole bunch of dividends, dividend paying companies versus non-dividend paying companies, and how they perform over the past like 30 years. It shows the growth of, if you would have put $10,000 into the S&P 500 in 1970, and it just compares dividends reinvested versus no dividends at all, price appreciation only. So this gold bar, if we had invested $10,000 in 1970, at the end of 2019, we'd have $350,000, which doesn't sound bad. But if we would have reinvested dividends into that, we'd have $1.6 million. So these dividends, you know, this big blue blotch on the chart, that looks like it matters. It looks like that matters a whole bunch. Then they have another one where they break down different kinds of companies, to companies that grow and start their dividends, all the companies that pay dividends, companies that just maintain dividends, companies that don't pay dividends, companies that cut their dividends, and then just an equally weighted S&P 500 index, and companies that grow their dividends outperform, companies that pay dividends outperform. They just outperform companies that don't pay a dividend. Non-dividend paying companies, you know, averaged 8.5% from 1972 to 2019, and dividend payers, you know, 12, almost 13%. So I know we can find companies like Tesla and Amazon and Google that don't pay a dividend, but they've outperformed everything for like the past 10 years. But as a whole, you know, dividend paying companies seem to outperform non-dividend paying companies. And that makes me feel good. That's why I like to invest in dividend paying companies. So what do you guys think? Do you guys prefer to invest in dividend paying companies or growth companies, or what do you like to do? What's your favorite company that you're investing in right now? And if you learned anything out of this video, if you're still watching, give me a little thumbs up. I'd really appreciate that. Subscribe to the channel if you haven't. Put some other videos over here that we can watch. They'll be pretty cool. And then I want you to have a good day, all right? Justin out.